A lot of people are asking, why is Palantir falling? It's at the moment down 6.5% after rejecting that psychological 200 level, in part because it stopped at 189, front-running that 200 psychological level, and second, potentially because Jim Cramer said nothing is going to stop Palantir from getting to $200, but that might be a topic for a different video. Instead, we need to talk about the Citron research piece and see if they have any credence to what they're saying. It's a short piece on Palantir, so my goal is to take a middle-of-the-road analysis here. I want to give you bullish information and bearish information based on what Citron is saying. For example, I'll start with something bullish here. Goldman Sachs has a great piece in their America's Technology section. They've got a whole PDF basically outlining the pricing power of how companies could, in the future, not only take potentially value-based profits from productivity that companies experience, in addition to just seat-based charges, which ultimately lead to a compression in prices or costs for AI, but more profits for the good AI companies. One of the examples of those good AI companies they give is Palantir, where basically they say here, Palantir's engineers can help a company fix their data, then put it together into their ontological system to cater AI to a specific business. This is why Palantir gets these big contracts. And because you don't have to build out some kind of fancy software UI, you could just rely on essentially an LLM, like a chat box to talk to engage with this data. You actually have significantly fewer costs for AI or software companies to set up custom AI for businesses because people could just integrate with the chatbot, which doesn't really take a lot of custom UI, which is brilliant. Like, the user experience is very straightforward and basic. So Goldman's actually really bullish over the next 5 to 10 years on software. Obviously, they talked a lot about Salesforce and the value that Agentforce can provide, and they've got plenty of other that they talk about here in this piece. Including here's some of these other companies: Snowflake's Arctic model, optimizing for enterprise workloads and analytics, delivering low latency, cost-effective inference inside of the platform. They, by the way, also mentioned that inference costs coming down should be good for companies like these, but also companies like Palantir obviously benefit from lower inference costs, which is really what the DeepSeek moment was all about, was telling us and showing us that, hey, yeah, we might want to train with the best chips available, the best Blackwells or whatever, but we can infer with cheaper chips, the A100s, H100s, or maybe even, lower scale or lower tier chips beyond that. Anyway, ServiceNow, Salesforce, Twilio, OneStream, Pigment, and so on. So they give some examples here, but let's talk about now the sort of more bearish side, which is unfortunately what we get out of this short piece here. So Citron Research basically makes this argument that Palantir's valuation on a per revenue basis or a price to revenue basis is essentially kooky dookie. So what they do is they say that OpenAI is projected to generate about $30 billion in revenue next year. So think about that, $30 billion in revenue. All right, so how much money does a Palantir make relative, right? Well, Palantir makes about, on average, $4 billion now. We just had our first $1 billion quarter. And so if you annualize that, multiply by 4, you get a $4 billion quarter. So Palantir obviously has great income growth. It's been a phenomenal exploder in terms of what it's been able to pull off in terms of growth. And that's why people have been so excited about it. But it's still a fraction of what OpenAI is projected to bring in. OpenAI bringing in about $30 billion projected in revenue for 26. Of course, net income is going to be a different story. Palantir, $1 billion per quarter. Or if you take the growth and add in growth that people are projecting for Palantir, you could get as high as $5.6 billion for the end of 2026. The Citron piece is basically based on this idea of, all right, if we take a price to revenue multiple of OpenAI, which they argue is the highest multiple of any SaaS stock in the world. So basically the multiple of 17 is already insanely high. Then what you end up getting is a Palantir fair valuation of 17 as a multiple times 5.6, their revenue, And then of course divided based on how many shares you've got outstanding. They see a valuation of about $40 per share. Okay, that's their take. The reason they value this based on how many shares outstanding is because we're taking the valuation here, right? So price to revenue multiple is the way they're looking at it. So what's the market cap of the biz, and what should it be divided by the annual revenue, and they get a multiple here. They say this should be somewhere around $40 for Palantir on a share price. Now, obviously, a lot of people look at that and say, hey, that's ridiculous. It shouldn't be that. Palantir's got phenomenal growth. And that's something that Citron mentions as well, is that yes, Palantir has phenomenal growth, but when you compare it to OpenAI's growth, it doesn't really hold a candle to OpenAI's growth at the moment. And this is where some people say, well, OpenAI is a bubble. Right. But that's exactly what Citron is arguing, that OpenAI, if you take OpenAI's valuation and apply it to Palantir, you still end up with a stock that's potentially 4x more expensive than it should be. Now, what I always like to do is I like to take a PEG ratio analysis. So I do a little bit of a different analysis than a company like Citron. So I like to look at, what EPS growth is, which is something you're not getting with OpenAI because we don't actually have earnings per share for OpenAI. For all we know, they're spending every single dollar of this just trying to grow the business or advertise the business or build out CapEx or whatever. And so if we look at a PEG ratio, which we can't do for OpenAI, but we could do for Palantir, we could take the current share price of 163 divided by 65 cents. We're trading for about 250 times. That's not necessarily bad. It just means you have to divide it into growth to see what the multiple is. For a company like Palantir, you should really see it somewhere around a 2.7 multiple. And so what we have for growth over the next 4 years is 32.2, 35.66, 41.58, and 38.53. Those are percentages. So divided by 4 years. Oops, I made a little mistake there. Keep in mind that these numbers are Wall Street estimates, so I'll give you my estimates in just a moment as well. Divide that by 4. There we go. It works out to about 37 times. I'd argue they could probably be closer to 40 to 50%, but let's run that for a moment. So if we take 250 divided by 37, they're trading for a PEG ratio of about 6.7. And if we take my estimate, they're trading for a PEG ratio of about 5. So in my scenario, they're probably twice as valued as they should be. They should probably be closer to 8. And if you take the Wall Street estimates of growth, they should probably be closer to, let's go 37 times the EPS, probably closer to 2.67, about $64. So Wall Street on a fair value PEG basis puts them about 64. Citron puts them at about 40. Kevin puts them at about $80 on sort of a fair value, right? The issue, though, with Palantir is not that the fair value matters, though, right now. It's actually that people are looking at Palantir as a long-term opportunity to actually benefit and capture capital from the AI revolution. And I think that's potentially what's expanding some of the multiples here. See, OpenAI's got this phenomenal TAM because you can really address, you could sell this product to everyone, right? Which is great. Like everybody can have a GPT product until, of course, they get unemployed and, they can't afford it anymore and they just use the free version, which is a real risk factor. OpenAI, they talk about seamlessly converting free users to paid users, whereas Citron says Palantir relies on large long-term government contracts and competes in the enterprise space with lumpy, less scalable revenue. This is somewhat true because Palantir's engineers with their AI boot camps work to essentially set up companies on their platform, and then, of course, the product becomes very sticky. I'm not entirely sure how sticky an OpenAI product is. So honestly, in terms of stickiness, I kind of give Palantir a little bit more stickiness, actually potentially a lot more, because if there's a better, if Grok is better than OpenAI, why am I going to pay for OpenAI? I'll just cancel the subscription. I'll just use these free models. In fact, I think there's an argument to be made that at some point in the future, a lot of the OpenAI, the Groks, the Copilots, the Meta AIs, they're all just going to be like a free service, just like Wikipedia. And the companies are really going to subsidize you using it because they want you to use their product so they can mine and harvest your data. A company like Palantir doesn't, in my opinion, have that replacement risk because they built out their system essentially inside of the very companies that they sell to, which I think gives them massive staying power. Now, Citron recognizes this as well. And so then they talk about, well, you have competitors like Microsoft and Databricks. And Databricks, in fairness, they've got great options as well. Databricks is a fantastic product where you could use a cloud system to help you set up various different machine learning systems, which you can then combine with LLMs to not only chat with the LLMs to extract data from, but also to refine your data and your weightings and otherwise. And it's all cloud based. They don't really have any on-prem solutions. It's probably easier for companies to get started with a public company like Databricks, and Palantir's got like 800 customers, so they're not like as big in terms of a reach as Databricks, but maybe that's a good strategy. People like this idea about how well Palantir is integrating, and so Citron, this is where I disagree with them. They say that Palantir faces stiff competition. I'm actually not sure that they face a lot of competition. And commercial growth at Palantir is growing faster now than government growth rates at Palantir, which is really bullish for Palantir. Even Citron says that Palantir's stickiness is real. So even at a bear who's now shorting Palantir, talking about diminishing returns, they recognize that Palantir is a really sticky company and product. And I don't actually think they give a fair shake to Palantir in terms of how integrated they are relative to some of these other companies. And so that's instead where, they come out and argue, oh, well, hey, here's a company that should be trading for $40 a share. Again, taking 17 times 5.6 gets you about 95 billion divided by shares outstanding, right? That's how they're getting to the 40. Because if you divide by about 2.4 billion shares outstanding, you get to roughly $40 a share. That's roughly how they do the math, right? But, I feel like their argument is somewhat weak because they even have to get into talking about insider selling, which, I mean, no surprise when a stock runs up, insiders are going to sell. I think insider selling is typically a bad indicator of stock future performance, whereas insider buying is usually a really good indicator of insider performance. So while I think Citron has a point that, yes, the valuation is stretched for Palantir, I don't think it's fair to compare Palantir to the likes of OpenAI just because the stickiness here is massive, which is great for Palantir, whereas the stickiness at OpenAI is very, very low. I think OpenAI somewhat risks a here today, gone tomorrow phenomenon where like there's such a gem today, everybody wants them today, they have the first mover advantage. But as we get better products at lower prices or even similar products at lower prices, OpenAI's stickiness to get people to continue to fork over $20 a month or $200 a month or whatever will fade because there will be other options that are good enough. And frankly, like myself as one of them, I used to pay for the $200 subscription to GPT. And I would get just as much hallucination in the $200 monthly subscription as the free version. So now I personally prefer to just use Grok and cross-check it to the free version of like a Claude or GPT, and I just don't pay because I kind of feel like we're starting to commoditize and the extra you're getting for paying for these services isn't really worth it. And I see my own lack of stickiness for these products as a red flag for the broader market because and I'm not trying to say that I'm early. My wife tells me I'm early all the time, but that's again also probably a topic for my OnlyFans. I mean, my Meet Kevin only. Okay, I'm just gonna move on. You really have a Palantir product where I know there are companies that would love to work with Palantir, but they can't even get a call back from Palantir because there's so much demand for companies to go to Palantir. You can't even get a call back from them because Palantir has a limited number of engineers that will set up these products. And so it's sort of like you're on this waiting list to get in for this product. So I think Palantir is kind of in the land of its own. And it's a really impressive company. In fact, back when this was $20 a share, I was one of the few people on YouTube, you can go back and watch the videos saying, Palantir is real AI. That was back when we were like questioning, like, oh, there's so many companies that aren't actually offering real AI products. I'm like, well, Palantir is a real AI. It's as real as it gets. Because they really were a big data company that just sort of rebranded as an AI company. But that really is what we wanted anyway. So it doesn't really matter that they rebranded. It was smart that they rebranded. But I mean, Palantir has always been the big data play. So, something to pay attention to. Yeah, that really that puts us in a position where, yeah, there's a sell-off now, in part because you have a Citron researcher who's shorting and doing well on the short right now. But you also have a lot of fear going on in the market broadly, which I think creates a shorter-term potential buying opportunity because of the odds that Powell is probably going to hawk to us and might even set up for an interest rate hike, which would be very unideal. Of course, the good news out of all of this is you can still get a tax write-off or check with your CPA for signing up for the Meet Kevin membership. Use coupon code JHOLE before it expires on Friday. You get all 8 courses, every trade alert, including the 10 buy list that we're going to be shopping for and buying over the next 8 weeks. The 10 buy list to hold for 10 years, so the 10 stocks to hold for 10 years. That'll be coming up soon, which will be great. You'll get that, as well as your daily alpha report every day the market is open, private live streams, and all the courses. Stocks and Psychology of Money, 0 to Millionaire Real Estate Investing. That's a huge one. Build wealth through wedge deals. Sales, even if you're not a real estate agent, sales is huge. Do-it-yourself property management, rental renovations, YouTube, how to get more stuff done with AI, Trumponomics, big Trumponomics lectures coming out as well, still this year on what we're doing with, the Big Beautiful Bill and how to implement some of the components of the Big Beautiful Bill, which is very exciting. So a lot coming. So check it out over at beatkevin.com. Look forward to seeing you a part of it.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.